We are back. Welcome to the Greenleaf podcast. Today we have a couple awesome subjects that we're excited to talk about. First, we're going to go through really looking at data centers, which are always super hot, but compared to self-driving cars, kind of compare and contrast those two opportunities that are out there right now. We are going to go through just some cap rate pricing and seeing what's out there in the market, what we're seeing right now. We're going to talk about apartment and multifamily, I guess they're the same thing, rental rates, and then we're going to wrap up with the Doge tracker and talk a little bit about government leases, which have been hot on the radar for the Doge team to cancel. So I guess cancel, or however they're getting out of them. But so, all right, let's first start with robo-taxis versus data centers.
Yeah, it's interesting. You know, these are going to be two big demand areas for energy. And we're talking about as a country where we need more energy resources, whether that's coal, nuclear, however you want to kind of position that. But we need more energy.
I don't know if you can say that first one.
and these two are going to be competing for a lot of energy, and also they're going to be competing for location that they need to be relatively close to city centers where people are, because data centers need to provide data to consumers, and the robo-taxis need to be where people are living. So I think there's going to be the land battle at some point between data centers and robo-taxis.
That both need a lot of power.
And both need a lot of power, both need a lot of land.
Yeah. The power consumption that, if we were to just say, hey, we're going to switch all of our cars from gasoline power to electric power, like tomorrow, I think everything just
they'd be Walking Dead really fast.
At that plant. Yeah, it's just not going to work. So if we look at data centers, super expensive to build. Obviously, kind of anyone you talk to is saying, "Oh, data center. Who has a data center deal?" Like, no one.
I mean, we're talking about $1,000 a square foot to build a data center. We bought this property that we're in right now for $85 a square foot. Like,
vastly different.
Yeah.
But these big data centers, they all want to have basically unlimited power supply that's cheap, and we just don't have that. So, data centers seem like they're just more of like you're swinging for the fences trying to hit a home run if you get that deal done, or a grand slam to do one of these monster mega data center deals. And
you have to really build them where either really, really close to a power plant or where there will be a future power plant. I mean, one of the benefits we have in the Atlanta metro area is that we had the last nuclear power plant that was built, Vogtle, right? The last one in a lot of years, went live for us.
That's because we don't know how many years.
Yeah.
30, 40, who knows how many years.
A lot of years. They're trying to, rebuild these other nuclear sites across the country, but nothing's really been approved yet.
Yeah. Yeah. And data centers, it sounds sexy, but I think that's just for a regular investor kind of person. I think they're kind of like too pie in the sky. It's like, just invest in a publicly traded data center company.
Right.
It's probably easier than trying to go line up some crazy data center deal.
Exactly.
But car storage seems much more like there's an opportunity. It's kind of a wide open market. It's not even really sure how it's going to play out. But if you think about it, there's been a lot of discussion lately on Waymo, which is coming to Atlanta. Excited to see that happen in Atlanta. Right now they're in Phoenix and LA. I just took one this weekend.
They're in Phoenix in a huge way. I mean, if you go to an intersection in Phoenix, you're going to see at least a Waymo in every single lane.
Their intersections are also enormous.
Yeah.
Why are their intersections so large? But no, I mean, Waymo is fantastic. I just took one this weekend in Phoenix, and it was like a third of the cost of Uber.
Did you find it roller coaster feeling or nauseating by any means, or did you find it very natural to just sit down and go for a ride? I mean, I'm less extroverted, so I was like, hey, this is perfect. My wife and I were just sitting in the back, chatting away. I was like, this is great. We had a good time. Yeah. So no, I mean, part of me too is like, I know this thing is an electric car. It can go really fast. It's kind of going like 30. Right.
I was like, punch it. Let's get there. I don't think it's doing that.
Right. So we have Waymo, we have Tesla, and Uber's trying to make a play for this as well to see where they fit in.
Yeah, but they got to buy something or partner with something. But Tesla's supposed to be launching their self-driving stuff in June in Austin. So the Cybercab? I think it's a Cybercab.
That's like the bus van looking thing?
No, that's just like the Model 3, but with no
Oh, yeah, okay.
That's going to be supposedly in June. They're always a little aggressive on their timelines. But from the real estate perspective, self-driving cars and the electrification of this opens up a whole lot of opportunities in the real estate space. So we really want to dive into like, what does that look like from real estate? We know a data center at $1,000 a square foot, it's kind of like, all right, next.
Yeah.
Like, what's next? And when we look at self-driving cars, and even to the point of like, there's a couple ways it could go where you have owned fleets that all have to return to some garage at night, some location in charge, and then be cleaned and maintained, like clean the inside out, make sure the tires are pumped up, make sure they're working in good condition. Or the version where maybe some people have these and you've got an extra car and lives at your house, and then it heads out and earns money for you on a daily basis. Could be those, but it's pretty wide open on what the impact to real estate is going to be. But overall, there's probably going to be need for less parking if less people are driving into city centers. And then there's going to be a need for where you store them and how they charge.
Yeah, so if you look at Atlanta and you look at like where is the availability of space to park, let's round it, 10,000 Waymos, maybe 100,000 Waymos, who knows? I think you're looking kind of east and west on I-20, not north and south on 85. It's just, there's just too much density north and south. East and west already have a lot of industrial stuff. If you drive east or west on I-20, you'll see a lot of trees, a lot of open land. I think that's where that play would be. The question is can you get the power supply there? And then if you go to the city center and say, why don't we just use the garages that are already built? The problem with those is they don't have the power supply or the power hookups per spot. If you take a parking garage that say holds 1,000 cars, that would be a very large parking garage, but it needs a charger at every single stop.
But that could be the play of buying. You could basically have. We look at retail space, and you've got Gen 1, Gen 2, Gen 3 retail of what does that design and that footprint look like, and those change over time. All the current retail needs like a drive-through. Like they're saying, how do we get a drive-through in this place? And that's what they want. But that could be like a Gen 1 parking garage, right? Right now, like the Gen 2 parking garage is going to have higher clear spaces, easier to navigate through. Maybe the Gen 3 one is how do you take an existing parking garage and electrify it so that you can have a charging port at every location. You can have self-driving cars come in, restripe everything so it's easy to navigate and they know where they're parked. But then also as soon as you come out of, call it like whatever generation parking garage now, it's like you just leave and you exit right onto the road. It's like, are people going to walk to that parking garage, just get picked up there? Or is it going to drive like a block around the corner, pick you up and go? So I think there's a play for taking parking garages and then how do you convert those to the new use, which would be how do you prepare an old parking garage almost in any location to then be ready to have self-driving cars?
Yeah, I think that's a great point. The Atlanta airport's rebuilding the whole south parking section into a giant parking garage. I'm curious, I haven't looked at this, but if they're considering this and if they're putting more chargers than they currently have, they have a small charging section right now, but I could see them building floors of charging sections. Yeah,
and that's you've got other people that are just driving their electric car there, or the Waymo, the self-driving version, where you're just getting dropped off and you're leaving.
Right.
In theory, you've got a lot less parking needs if everyone's taking a self-driving car that they're not going to actually end up parking there.
Right.
So maybe they're building this huge infrastructure for something that's not going to be there.
Right. Yeah, who knows? Yeah.
But I think there is a play in the real estate play. I mean, it's not $1,000 a square foot.
No.
Parking garages sound less enticing than data centers, but in our investment thesis, that's kind of like, that sounds good.
And parking garages trade. I mean, you can buy them on a cap rate just like anyone. And so we can potentially look at buying a parking garage that say they trade at low cap rates, say a 6 cap rate, and retrofit it and electrify all the spaces. And maybe we create a lot of value and it ends up being a 9-10 cap rate deal because we're the only garage in Atlanta that can store Waymos.
Yeah. And you look at, there's different brands. We were talking about Home Depot the other day. Home Depot owns all their locations. Some places own all their real estate, some don't. So how's that going to play out? I think there's just a lot of opportunity in the self-driving space that's going to impact the real estate component. I think there's also parking garages you're not going to need. Mm-hmm. It's like what differentiates the one between, hey, this parking garage is now defunct, like Class C high-rise office that's defunct. Right. Like what's defunct and which one can we take and convert to usable next-generation storage for self-driving electric vehicles.
And I don't think the reality of the impact of self-driving cars, I don't think it's that far off on the horizon. Like if you were to buy a parking garage today and make this bet, by the time you're done getting the power to it and putting power in all the spots, you're talking 18, 24 months. I think there's been a lot of Waymos in Atlanta in 24 months.
Atlanta specifically, once we start seeing these Waymos whipping around, all of a sudden it's like...
Game on.
Yeah. You see it. It's right there. It's like, oh, this is real. Mm-hmm. And a lot of people in Atlanta will take their first one for the first time. And they're like, well, this is awesome. I got to get in more of these.
Were you saying that the price difference between an Uber and a Waymo when you were in Phoenix?
Yeah. No, it was like a third. It was $15 to take an Uber from the hotel to the airport. It was like $60 to take Uber.
Oh wait, so the
25%, yeah.
So the Waymo was 15 and the Uber was 60.
Yeah.
Wow. That's a big difference.
Yeah, and he came right up to our hotel and I'm like all excited because the Waymo shows up.
Yeah.
Half the time, if you get an Uber, you're like, I hope this one's nice.
Right.
I hope it's clean inside. But the Waymo was great.
Right.
So it'll be interesting to see how this plays out. But I do think there's a play for how do you take the location you're going to park these things. Waymo's fully vertically integrated, but it's not going to be that way forever. They're a tiny fraction of the cars on the road right now. As it even goes from like, I would call it 0% right now, to 1%, 2%, 3%. Now you have a huge number of vehicles that you're going to see that are going to need a home.
Absolutely.
Somewhere.
Yeah, I mean, when we were at the All In Summit last fall, we heard the CEO of Waymo speaking, and it was fascinating when she talked about how Waymo gets the knowledge of I think it was like a driver's lifetime experience every hour, because it's one driver for its entire fleet. And so the entire fleet is constantly gathering data and putting it into their central database versus us as individuals that will drive for, say, 50, 60 years of our life.
Yes.
And we won't be able to accumulate the data that Dave has accumulated.
I know.
Over his...
Waymo probably won't ever be as good as I am at driving, according to my wife. Not according to my wife. So, all right, well, self-driving, the impact to real estate, I mean, it's going to be there. And there's going to be some big opportunities if we can figure out what exactly that means. And I really think it comes down to how do you store them and where is that going to be? How are they going to be electrified? And really taking that, we're going to start looking at parking garages as like, what generation are they? And the next generation of it is going to, have this built into them. So, okay. Next subject we want to touch base on are cap rates. We always get questions around like, hey, what's next? What are the opportunities out there? Electrified parking garages, but what opportunities are out there and how are things trading? And right now, the most information we're seeing is really around two fronts. One is the flex space that we're looking at a lot, and the other one is the retail space that we're looking at a lot. So let's start with retail and what we're seeing on those cap rates.
Yeah, I mean, we're still seeing this really wide spread between the bid ask. So, we're looking at interest rates. We're looking at the spread of cap rate to interest rate. We would like to see a minimum of 200 basis points, meaning that if we buy a 7 cap rate deal, we can get debt for 5%. And it's just not there right now. We're seeing, in the retail sector, we're seeing cap rates holding in the 6.25 range, especially for like quick service restaurants. And debt is still holding around 7.5, maybe even as high as 8%. And you put amortization on there, meaning that you're paying principal and interest. Yeah. You're looking at like a 10, 11% coupon for your debt. And there's no positive leverage right now in the QSR space, specifically in retail.
Yeah. So that's certainly hurting our deal flow of stuff we're looking at, but it's definitely hurting deal flow as a whole on the retail side. It's just not there. We obviously, as interest rates started rising, we were seeing that, and we were optimistic that gap would widen. It has not happened.
No.
And pricing really has not changed.
No.
Most are willing to just hold, or if they are selling, they're like, look, we're still going to sell to 6 cap. So new buyer, you figure it out.
Yeah, and that's why we've seen transaction volume, kind of hold. The last couple of years, it's been about 20% off of the peak. Peak was in 2022. We're not really seeing that rebound yet. We'd like to be on the buy and the sell side. We'd love to kind of sell some properties, buy some more properties. But the difference between even one of the office properties we were looking at the other day, it was $140 a square foot for called 60% office, or we're used to buying that for around $80 a square foot.
Yeah, that's the other segment. If we look at, retail, still not a whole lot of opportunity to buy stuff because we're literally seeing like 20% of the historical volume over the past 2 years. If we look at that on office, it's a little weird. The pricing has almost gone up. So the price, everything we're looking at on the commercial, the office side is really a price per square foot. That's how we're valuing what stuff is. And then we look at what's just the overall occupancy. Now, those are very general numbers because it could be a net lease, it could be a gross lease, it could be a 2,000 square foot suite or a 50,000 square foot suite. Those things are completely different. So you can't just say, price per square foot and it all evens out. However, when we look at our price per square foot, stuff right now that's transacting roughly the areas we work at, like the 130, 140 a square foot is just too high.
And the other part that we're seeing is that as we look at the net income of the properties, it's somewhat fake. I don't want to call it totally fake, but like the revenue is usually pretty well accounted for. But what's not accounted for is like the true expenses of the property. And they're really being kind of overly cleansed out that we're seeing kind of revenue in the, call it $10 a square foot range when we generally expect to see expenses around $3, $4, maybe $5. And they're reporting revenue around $1 to $2 a square, expenses around $1 to $2.
We saw a deal we underwrote yesterday, 2 days ago, that was 70 cents a square foot in total expenses. Yeah. Which just our taxes, insurance alone are going to blow through that number.
Right.
So we couldn't touch those expense rates. We're like, how are they doing that? We'd love to be able to do that.
Right.
But no, our expense cost per square foot is only increasing. It's not 70 cents a square foot. Maybe 2 years ago we were in the 3 to 4 range, and it continues to creep up from there on an annual basis. So when we look at a deal and they're saying rents are 10, expenses are 70 cents a square foot, and you're gonna trade that at a 7 cap, it's like, well, expenses are really $3 or $4 a square foot. That means there's only $6 of NOI versus $9.30. That's vastly different.
Yeah, and as a result of that, we're not seeing any transaction volume. We're bidding 30, 40% below where they want the price to come in at. The brokers guided them to a price based on fake NOI, and it's just not working. Nobody's moving.
Yeah, and if we make too many lowball offers or the stars aren't aligned in the conversation, it's like we don't want to just annoy people. Right. So it's more like, okay, we'll watch from the sideline and see how that transaction plays out. If there's an opportunity, it used to be called like 5-6 years ago in the multifamily space, we'd put offers in and be like, hey, we just want to be like 4th position. Let us know how it goes. And we come back and we executed a lot of deals at a 4th place. And you kind of come up there. But some of the commercial stuff, I don't know if there's 4 total bidders. So there is no 4th place. There's no like holding spot that you can be at on a deal right now. So it's really just another thing where pricing expectations are higher than we're at, and just constricting deal flow. So, yeah. I don't know if that's going to change anytime soon. It just
is.
Yeah, that's where it's at right now. Things to get that to move. It's like, what do you think it would take to get that to move? Like, how are we gonna?
It's probably going to be a significant change in interest rates. Probably interest rates need to come down pretty close to 100 basis points. Lending realized interest rates, not just the federal funds rate.
Right.
So like the 10-year Treasury needs, currently trading around 4.5, probably needs to come down to 3.5. And that would basically flow through the market that our lending rates, instead of being 7.5, would be 6.5.
If it comes through, though, you could look at that banks and be like, we just make more money now. We'll keep the
spread.
Debt rates at 7.5 and widen our spread. Yeah. But definitely, it's a good play if you're the one borrowing at 3.5, selling at 7.5.
Right. But what we thought would happen is that there'd be more loan maturities, and we'd see people forced to say, I need to move. Yeah. And we're seeing that banks are willing, in a very positive way, but banks are willing to extend with them and give them more time, which is that's a positive thing from a lender borrower standpoint. But it's not releasing that deal to the market.
We always used to joke and talk with our bankers that you're basically, the bank's pregnant. They've got this loan, And eventually,
to give birth.
Yeah, they got to kind of move it out of the house.
Yeah.
And turn that loan over so we can do more loans. We always have lending capacity when we're doing deals that we hit with a bank. They can only do so much lending with one borrower. Probably a good thing, right? But if you're full with one borrower, you're kind of like, well, there's no new transaction that's going to happen out of that right now. So,
So we will see what the market has for this year.
We're kind of waiting on that one, and we're really on the sidelines because we don't want to make just lowball random crappy offers. We want to be buyers at our price point, and we're not trying to be ultra cheap. We're willing to pay, but not we can't buy on NOI that we can't execute on.
Right. So as a result, we're looking to be a little bit more creative. Maybe we're not buying the deal. Maybe we're working with other partners that have their deals. We can do some lending with them, coming kind of, I would say, more unique ways than we have historically. And we're seeing some interesting stuff. Yeah.
I liken it to trying to get through a maze. If you hit a dead end, it's like you don't just quit. You just turn around, go see what the next route you can find is. So that's what we're doing right now. But sometimes in the commercial space, it feels like you might be in the maze with the lights off for a little bit.
Yes.
So we got to look for some lights.
Yeah.
Cool. Okay. Next topic is we want to talk about just rental rates on the multifamily side and what we're seeing on our assets and then how that compares to what we're seeing in the market as a whole. So we use CoStar.
Yeah, we used CoStar and really surveyed the last 12 months.
Along with every other real estate investment group that's pitching in $2,000 a month.
There you go. Yep. It's a great tool. It's really the primary macro level tool to get data.
Yeah.
So, and we use CoStar anywhere from, I would say from this standpoint of like macro level data to talk about the market, also to look at specific deals, also to shop deals. Like we can pull up the owner's information, the manager's information, broker's performance. So it has a lot of really great data that allows us to, hunt down deals.
Yeah, those guys, they grind it out. I mean, they're making the CoStar team. I mean, they're making phone calls nonstop to track down real estate. Yeah. I mean,
all manual.
There's no like magical source of AI information. It's like CoStar's out there calling all the transactions, all the deals, see what's going on, find rental rates. So it is helpful. Mm-hmm. But yeah, the trends that we're seeing right now are stuff we had been talking about. Now it's kind of coming, it's kind of happening. Yeah.
So we basically looked at the trailing 12 months on Phoenix, Dallas, Fort Worth, and Atlanta. And frankly, they're all incredibly comparable. Dallas is about 50% larger than Atlanta or Phoenix. And Atlanta and Phoenix are really comparable in size. And what we're seeing here is that over the last 12 months, rental rates are down about 1.5% to 2%, and vacancies are up to 11 to 12%.
In all three markets.
In all three markets. There's really no distinction between the three of them. They're all within a really tight margin of error of each other. It's kind of scary if you think about it if you're a Class A developer and you just delivered your units, and all the other properties around you are sitting at somewhere around 87, 88% occupancy, and you need to go for a lease up and what concessions you need to give, it's pretty terrifying.
Yeah.
Especially when you broke ground 3 years ago in the middle of 2022, the hottest apartment market in the history of time, to now you're delivering units in a really soft market. This isn't a catastrophic change, but it is a very significant change compared to the past 10 years.
You got to think about when we're modeling deals and we're looking at how are we going to put together a deal, especially if it's a syndication deal and it's not a individual buying a deal for a longer term asset play. It's like if it's a syndication deal that's trying to generate cash flow returns to LPs, most models are not putting in that we're going to have negative rental rate growth forecasted year over year, and kind of positive expense growth. No one's putting that into a model. So it's going to cause some havoc when we realize expense growth and negative 1% rental rate growth.
Right.
So
we have all this data that's showing these trends of, we're happy to share these, but, vacancies rising, rental rates dropping. And then I'm like, you know what, let's pull up office and just look at the last 12 months of office and compare some notes. And on the laddering, yes, office took a little bit more of a deeper dive over the last couple of years.
A little bit.
But we're coming in on the tail end of that.
That's a very nice way of saying
it. And we're coming in on the tail end of that. We're seeing office rents up 2% year over year, which is pretty great. And then we're also seeing that office vacancies are declining, that they were kind of in the low 20s, say 22 to 20% in these three markets. And now they're in the 16 to 18% range. So we're seeing a very positive trends for the office market while seeing really negative trends for multifamily. That's why we're big buyers of office right now. We're big believers in what's going on in that market.
And a lot of these metrics too, it's hard to just like shift them dramatically. Like once it starts, I mean, these are slow moving waves as they go through the market cycles. So everything's pointing to the fact that multifamily we've talked about, where we're going to have some rental rate headwinds for at least another year,
right?
A year and a half.
Yeah.
So that's what we're seeing on it. However, execution wise, our multifamily, we had positive rental rate growth in 2024.
Yeah, we have give or take 1,000 apartment units, about 500 mobile home units, and our mobile home units are
stable.
Yeah, very, very stable. We're seeing good rental rate growth. We're seeing controlled expenses and a very, very high occupancy. And then on the multifamily front, it's not as strong as the mobile homes, but it's still very strong and positive in our direction. And we're keeping a close eye on it to make sure we're still seeing increasing NOI as we hold it.
Yeah, we look at making sure that we're seeing margins either maintain or improve over time on a quarterly to annualized basis, but it's getting tighter and tighter. It got revenue increases declined. So we saw positive revenue growth every quarter in 2024, but that positive number kept declining. And now we're really looking at about 3% is what we think we can do in our market for 2025, knowing that the market as a whole, everything around us is seeing negative 1% as kind of the market trend.
Right.
Yeah. So.
All right.
Okay. Next, we're going to
now the fun stuff.
The Doge tracker. As I don't know if there's anyone that doesn't know about what's going on with that, the Department of Government Efficiency. But one of the things that they've put out is they started publishing all the stuff that they have been canceling. And one of the hot topics was, are they canceling government leases? Are they going to sell off government buildings? What are they going to do in that segment? And one of the things, we have a lot of government leases in different kind of departments of the government.
Yeah, I mean, we have a lot of federal leases and we have a lot of state leases as well. And the other part about Doge is, they are requiring everyone to come back to the office. So this evaluation of who's willing to come back, who's going to take the package. They're offering a nice severance package, and then really what's left. Yeah, and what they need.
Yeah, when we were first looking at federal opportunities, we came across them really from the medical side because we were looking at buying medical deals, and we also noticed and got some information just on the VA clinics, which were medical serving patient clinics. So we bought a few of those, and we like those because if you've seen any of our drive-by episodes, we go drive the property, we see what's going on here, and there's patients coming in and out. There's doctors there all the time, and this was still in 2020, 2021. Like, these spaces are being used, and that's why we like them. They also have a medical twist, and the VA clinic has their mandates of where they have to be able to serve their constituents and their patients. So we like those deals because when we went there were people there and doing things. Now, counter that to, we drove a huge number, at least 24 of the Social Security Administration buildings. Yeah,
the Social Security Administration, every time we walked in, the door was locked. So okay, what time do we come back? Like, let's just say I'm a customer and I want service. There wasn't really a great way to get service because nobody was working there. There were definitely no customers going in there because the doors were closed. If they were open, it was kind of hard to find anyone working. And the parking lots were empty and the buildings that they were in were empty.
But even the parking lots, that's why it's so important to get out and just drive this stuff. Mm-hmm. We drive the parking lots and you can see cracks in the parking lot that have grass growing up in it. It's like, no one's been driving through this thing in a long time.
Right.
There's just no one there. So we took that information. We're like, hey, we're not going to invest in any of these. We're not going to buy something if no one's going to that space. And we also look at the placer data and see this thing's flat. There's no one here, and it's been
years.
Yeah.
Yeah.
So The other part of that was post office. We had opportunities by post office, and we're just like, nothing looks like that's happening here.
Right.
So I would say, yeah, I mean, from a Doge tracker, those ones probably have some issues on those government leases. And most government leases can be canceled with notice within a year.
Right. I mean, one of the more interesting ones, which we actually had a lot of heartburn about, was we had this property under contract in Huntsville. It was, I think it was a Department of Defense lease. And it was a big, beautiful new property. It was like 100,000 square foot built in the last couple of years, in the last 5 years.
And Huntsville's a hot market. It's got great population growth, great rental growth, probably best market economics numbers in the state of Alabama.
And has that kind of Department of Defense foundation with Lockheed there and missile building and all that.
Yeah, there's rockets on the highway.
Yeah.
It looks pretty cool.
It's pretty cool. And the NASA Camp Center and all that. But anyways, the property we're looking at was a great property. And we go to drive it, and all the metrics, the NOI, everything checked out. We get there, like, it was like a Tuesday at 10 a.m., and there's not a soul. And this is a 100,000 square foot property, not a soul.
Yeah, it's like, where is everyone?
And they're like, well, we can't really get inside because nobody's been here in over 6 months. We're like, what? I drove all the way out here to tour the building. Like, sorry, like, nobody works here, but there's 7 years left on the lease. You want to buy it? Like, no, we don't want to buy this. Yeah. So we had to pass on that one. A couple other kind of like nuances with government leases, and we looked at a lot of state leases. These are not impacted by Doge. They're a little bit off topic, but the same general theme was you had to be really specific about state agencies. For example, like we have the city of Chattanooga and the state of Tennessee in our building at TVDC. Great tenants, great office workers. Everyone's there. They have an armed security guard at the front desk. They are working. It's great. We went to some of these other state leases like a DFAX or child services, and the amount of traffic going in and out of the door of a DFAX property was it was nuts how many people were going in and out that no other tenants wanted to be located near them. And that really hurt the value of the real estate. They traded at really high cap rates. And frankly, they can't really move elsewhere because nobody wants this kind of tenant because they have so much traffic. And a lot of times it's not the kind of traffic you want going in and out of your property. So we had to pass on those because of the value of the real estate was limited. So it's lots of nuances in government leases.
It just reiterates it's important to get out there and look at what you're trying to invest in and what you're doing.
Right.
You got to be at the sites. You got to see how they're operating, because sometimes it's good, sometimes it's bad.
Right.
But Doge overall, the idea that they're going to cancel some of these leases is definitely happening. If you look at just that Doge website, they list all the stuff that they've canceled. There's some talk that they may be able to sell some stuff off, which is like, oh.
Yeah. We can be buyers.
Can we
locations.
We look to be buyers if they're going to sell something quickly? But we haven't seen anything actually like for sale out of it yet. We've just heard, they've canceled a lease here and there. And overall, it was maybe like a dozen. So long ways to go before they have, I think, a more robust impact, which they're going for. Mm-hmm. However, haven't done it that much on the leases yet. But we expect to see more of that happening. And it's going to be interesting if some of those come in and they impact stuff in the Southeast. Those are definitely ones that we're going to go in and look at. Have we been to that location? Do we know that place? What was the placer information? Were there people there? Because if people are coming back to work, but they're not at that location, any business in their right mind should not use that location anymore or try and get out of that lease. So, cool. All right, that is our update for this week. A couple good topics on what's happening in the real estate market. If there's any questions, please let us know. See you later.